Good people, Crypto Sniper back at you. Yep, so time to post-mortemize something where we were 180 degrees incorrect. That's right, the Ethereum USD trade. In fact, I'm going to title the YouTube How to Be Wrong Like Me. And as is typical, especially if you put your head out there, whether it be on Twitter, YouTube or anywhere else, a lot of the lower level trolls and haters have come out and they've enjoyed the fact that we were inaccurate. And I'm going to make an important point that everybody needs to remember. Trading is a game where you will be wrong throughout your career, and repeatedly so. And the game is not whether you are wrong or right. The game is, over all wrongs and rights, do you make money? So that actually means not losing much when you're wrong and making a significantly more degree of profit when you're accurate. Or even better, not losing anything when you're wrong and actually even making a little bit of money, which our method allows when wrong. And I'm going to go into that. So how do you make money when you're wrong? In fact, when there's three things, there's actually three particular outcomes. And I went through this journey curve myself. So while we've got the Ethereum chart up, I may just do a little sketch for you all right here. When I first started trading, what used to happen is I always lost money when I was wrong. It goes without saying, and I lost more than I should have. So as a newbie, I actually see there's kind of three outcomes that occur. Making money, losing money, and neither, so break even. And there's also three possibilities when you make a trade call. The market does what you think it will do. Let's say it goes up. We typically break out traders, so we're looking for a move. It goes up and it goes up strongly. So you were right. Then you have the option you were wrong. And then you have the option where you're neither right nor wrong. It doesn't break in any direction. It doesn't do what you expect to do, but neither does it run your stop. So if I were just drawing a simple grid, I would go, right or correct, accurate, wrong, okay, inaccurate. And I'd kind of leave space for a neither option. Let's say you're expecting a breakout. Let's say you're not chasing in with market orders. You're not an entire beginner. You never really get quite put in. It just congests and continues to consolidate and you abandon the trade. So you're not right nor wrong, nor significantly wrong. It doesn't do what you expect it to do. And then there's the outcomes. You make money plus P&L minus P&L, and then I would just leave a line here for, let's just say, no P&L effect. 0. Let's just give it a 0. And here's where you start when you're a beginner. When I was occasionally accurate, I didn't make the money I was supposed to make. So I would make some green, and that's kept me enthused, plus P&L, but small. I even sometimes lost money because I would pyramid in, get excited, have 1 unit long, jump in, go, oh, it's definitely going in my favor. Let's say we thought this was going up. We didn't, we thought it was going down. It started moving in my direction. I'd jump in, I'd be later than I am nowadays. Then I'd jump in 2 units here. Then I would get shaken out by money management and do a forced close of 1 or 2 on that side. Then I'd see it going back up. I'd get frustrated and say, I knew it was going up. Jump back into here, maybe 3 to make up for the money I lost. feel good up to this point, then it pulls back down, and now it's taken a whole bunch of my profit back, and I would potentially cock up even a good situation. So you get moderate P&L, not super plus P&L. When it didn't do what I expected it to do, I would lose money, because I'd try force it. I'd try go help the market in the direction, as if me getting my shoulder to the wheel, pushing it up the hill, was going to get the market to move up. So I'd still sometimes lose. And when I was absolutely wrong, I always lost, and I sometimes oversized lost. Sometimes plus loss. And that was failure of money management. So as you can see, from those set of circumstances, I made minimal amounts of green, and I made max amounts of red, and I sometimes still lost when neither happened. That's just not a good situation to be in. And as a result, the overall P&L died. It was like having alimony to pay. You would fund an account. Sometimes it would last, sometimes you'd have some runs, but the long-term trajectory was heading towards zero, where you would spiral out. It would get really low, and you'd recognize it was low, so you'd take a bigger chance to get it back to where it once was before. Whether you were right that time, at some point you would do that again, because if you got positive enforcement for negative behavior, and let's say you did bounce it back up on that big chance, you would then say, great, let me do it again now. I've shown I can do it. And then you would have a money management event, and you would spiral out and fail. And then you'd lick your wounds, wait and sweat it for a while, and come back and try again. And here's where HVF method is awesome, in that eventually you'll get to a point where you don't lose. This is when you've progressed. It's not about the right and wrong. It's about whether you're making money. You don't lose very great deal when you're wrong. You have small loss. You lose nothing if it does neither the opposite of what you think or what you think. It just starts going a little bit off and is not looking like what you thought it was. You abandon the whole trade idea because you're not using market orders you haven't been triggered in, and you walk away. So it costs you nothing. So you forego that loss here, that no longer happens, and you forego the maximum part of that and eat small losses. And actually, when you're right, because we are trading a high reward to low risk trades. In other words, what we are risking, we end up getting P&L on the max side on winners. And in actual fact, if our average risk reward is around 6, which it probably is, you can actually be wrong 5 times and still be a winner. 5 times in a row and then a winner. So you're on a 6.5 risk reward average, which is, I would guess, on aggregate our amount. Had this been a downside break, it would have been deep in the 6 digits return for me. You become a significantly better trader. Now the journey from this column, and I've sat in this column, I've been in all columns, to that column can be 10 years, it can be 1 year, it can be 6 months, it can be 15 years, it can be never. For most people, it's never. I can tell you that. For most people lacking method, it's never. That's the hard and fact truth. And all the trolls that come out when you share a trade idea that go, you were wrong, you're the perfect counter trend indicator, those aren't guys that are making money, because they're focused on the right and wrong. They're kind of like the biblical hypocrite. I am good man, look at me giving charity publicly. And they're not focused on the actual outcome of whether you lost or you didn't. You lost money, how much you lost, And in the gains, how much are you making? And what is the net curve of your P&L? They won't be sending to you or sharing a 1 Bitcoin to 35 Bitcoin growth curve on Twitter or on YouTube. They are just stone throwers. They're professional stone throwers. So don't listen to them. They are not your focus, and they are focused on right and wrong. In actual fact, HVF Method sees us trade a method where we are far more regularly going to probably be wrong, given the risk rewards that we have, than right. So in other words, you shake your head, you take a very organized size loss, or you don't get triggered in the trade at all, no loss at all, and you walk away. And if you've discussed that idea with other people, they'll say, yep, that didn't work. And it's like, yeah, it didn't work. And it cost me nothing, or it cost me a very small loss. And then you get one right and your account moves significantly up. So by focusing on high rewards and low risk trades, you're reducing your probabilities, because automatically you've got tight stops, and automatically you're asking for big significant moves. You're not asking for ebb and flows. Now you get other methodologies that are trading that are pip stealer methodologies. I've seen people who've traded for 5, 10, 15, 20 pips with 1,000 pip stops. And they are winning all the time, stealing 10 pips here, 20 pips there, 30 pips, always on the ebb and flow. Look at that, I'm so good, I'm a regular winner, I told you to do it, I told you to do it. And their money management is 1,000 pips away. And they are winners, and they're winners, and it feels good, and they're winners. Until one event comes, somebody stands up, says something, and it smashes in. Because to make money on 20 pips, you have to have reasonable sizing. It smashes hard down through 1,000 pips. And they've just had 80 or 90 in a row winners. And they're telling you that they've got a 96.8% win rate. You'll see some of these bot adverts with that. 96.8%, 99, crazy numbers. And then the 1,000 pip comes. And you've just been working for a month and a half gathering 790 pips, and now you take 1,025 pip break. You thought you were up, you were already spending that money and how much you're going to leave, and your account was up, and boom, it's gone. Trust me, regular winners, high probability winners, usually end up with outsized losers at some point. So we're very, very selective about when we engage in the market on hot leverage. So we talk about the investment, the moderate leverage, and the hot leverage. And we will be regularly wrong. And things I say that I think might happen will often not do what they happen to do. The difference, and the reason why I'm doing slightly almost lesson-esque is don't listen to the people that come out and are all so great and stone throwing about whether that was an accurate call or not. Listen to the people that make money. Listen to the people that make money. And the reason why this method is awesome is we recognized that there was risk to this trade. We know that if we are wrong on this trade, because of the nature that we trade, low volatility to high volatility, we rarely slightly wrong. We are 180 degrees wrong. And you know what? It costs the same to be a little bit wrong than entirely wrong. That's the beauty of the strategy. You don't pay any more on your stop loss for being completely outright upside down, man on the moon wrong. You don't pay anymore. It costs the same. And because we trade volatility squeezes, if we're wrong in it going down to the downside, what it probably means is it's going to break out strongly to the upside. In other words, we know from nature of our strategy that we're 180 degrees wrong. We know a breakout move is coming almost surely. Can I control if Jack on Twitter or Square, some investment fund, is suddenly going to announce that they've just bought 50 million, and instead of holding dollars and treasury, they're not going to hold 5%, they're going to hold 100% Bitcoin? I can't control whether that occurs, and I can't control how the market's going to probably react. It's going to react bullishly to that news, most people will get, and that's exactly what you got. So let's have a look at the benefits of that. If it is not doing what you expect it to do, it's probably going to do in our particular strategy's case. Please note, our particular volatility squeeze strategy's approach going to do exactly the opposite. It's going to do exactly the opposite. That means it's going to push to the upside if wrong. Hence why I say we're never a little bit wrong. We're 180 degrees wrong. And that delights the trolls even more, and that's okay by us because we flip. And flipping is one of the hardest things to do because you get into a belief state about something's probably going to go down. So you need to learn that dexterity to turn. Imagine, and I'm going to show you how it turned out for me, you plan in advance what you will do if wrong. You're in a community that is always assessing the progress as to whether it's working rightly or wrongly at that given point. You're making sure you are staying very highly dexterous. So you're showing the dexterity to flip in the other direction if we turn out inaccurate. You are always keeping your eye on your ability to exit and sizing and the need if you suddenly had to close that position and potentially reverse it, or reverse it in another market that's even better set for the bullish state. So in our premium area discussing this Ethereum USD short, actually we looked at Bitcoin, and I will show you a discussion and a sheet that I shared, where in our premium area we went through the progress of our Ethereum trade and we highlighted what was concerning about us as it was making its progress. And it did start to concern us, and it did start to give us reasons why we thought there was a chance it may not perform. And also we reminded ourselves of the larger nature of the market and how it was set up and all the risks we were taking. So what were those risks? Let's cover them again for the benefit of understanding this trade. And this was deeply and detailed discussed in our discussions together. Firstly, the trade was a counter trend trade. So we are super macro bullish of the market, and yet this was a sell trade. I'm going to reduce the size of that. It was a sell trade. In other words, it was a trade against the overall macro potential of the market in a fiat proliferation game. So we were aware that there was higher risk already as a result of that. We then, this is specific to HVF, we pointed out that you didn't have a very deep, so the RL3 was not particularly flat. So this is a structural discussion that, as I say, you will learn if you are in our community. Book, by the way, to have a chat. You'll see and learn more in our losses and post-mortems than you will learn in our gains, apart from recognizing that the system is very effective. But the point we were highlighting was we had a lovely flat 1 to 3 there, but we actually had a higher line over here. So that had showed some buying up had come in. We would have preferred that level to be down here, supporting in the legacy funnel area. And then when we broke just and we feigned back in. So we did a weak, marginally lower low and rally, and then we came down and failed to move further. So you started to have possible double bottom structure, squeezing against our axis. There was no follow through on our triggering event. And then we saw the beginning of some impulsive upside behavior there. So we were monitoring its progress and saying this, and what's our big risk? Because we know our strategy and we only trade one thing, we could just be, we're expecting and waiting for the potential of 180 degrees incorrectness. Plus, because we're watching it upside down, we are removing our bull biases and bear biases. And on the same level, we noticed that you had a marginally higher high and then failed to push through. So this was our Ethereum chart upside down. So the RL3 wasn't flat, it was counter trend. Then on gold and other anti-fiats, we saw that there was in fact a falling wedge. So we correlate the anti-fiat, and we have been warning that at the same time gold might take a dip to the downside, there's also in our transgender pink a falling wedge structure, which in fact has now been broken subsequent to that. So anti-fiats, falling wedge potential in our scenario, both on the Ethereum and on the God market of all anti-fiats for now, Bitcoin. A falling wedge, and it broke. This came later, but there was the threat of it. So I'm showing you all the reasons we were watching where we might go wrong and where we were vulnerable. That was a possibility that could occur. And it was a possibility that not just on gold could occur, which is a very dominant anti-fiat market, but that on Ethereum you had a kind of small time frame structure here that we were making just marginally lower lows from, and that we could jump out of. So I called it the falling wedge threat. This is what we were discussing in premium. So the minute these three impulses looked like they had formed on the falling wedge, and we'd failed to press on and we bounced just to the midpoint and we started to be impulsive here, we're straight away concerned that the falling wedge may be triggering to the upside and that this is sustained support. So we are early in recognizing when wrong. This YouTube is titled, Learn to be Wrong Like Francis. Learn to be wrong like Francis. We were early recognizing when wrong and thinking and pointing rationally to all the key points that would highlight how we would be wrong. Counter trend risk is higher. Yes. Not such a flat low 3 as I've already described, which dovetails with the falling wedge scenario cast that I've just illustrated on Ethereum, and to a greater degree was also possible on gold that would see the anti-fiats move up. Then point number 4, which was of concern for us. Remember, this trade has not yet gone wrong for us. In fact, it's looking great. We had already bought in. This is the inverted chart of Tether. All that had happened is you'd had a touch and a small pullback. We'd got very heavily long, short in the normal chart, but on this, obviously it's an inverse chart. We'd got 350s, 2s, 350s. We'd got short. And at the moment it was trading 341. We're deep in the money, and we're already worried about how it might not work for us. Scientific endeavor is you seek to disprove your hypothesis and spot early warning signs that things are not going as they should be going before they happen. So number 4 was Bitcoin. So let's discuss what we were discussing on Bitcoin. Now Bitcoin, unlike Ethereum, which had quite a flat structure along the bottom and quite a deep squeeze across the top, which we like for spills. It's getting closer and closer to what traditional technical analysts call a descending triangle. Bitcoin was more symmetrical. Bitcoin was more symmetrical in all of this, and this is how Bitcoin was looking. And Bitcoin was a concern. Bitcoin was more symmetrical. Note that it has similar gradient below as it had above. It was less flat bottomed, and this overall structure was more 50-50 as to whether it could go up or down. Let's take the news out of it. Let's take the fact we now know the answer out of it. This was potentially a first structure in a new trend. And the other two blue circles I'll talk about later when I go into further detail on how to be wrong like a HVF method trader. So this was more symmetrical and was less confirming. It was ambiguous. It was, I could go up, I could go down. Could go up, I could go down. It didn't look as good for the downside as Ethereum, and Bitcoin is the crypto's god market and is the boss. So Bitcoin was walking the line. He wasn't giving you a clear nod, we're going down, and looking equally bearish. He was kind of, I could go up, I could go down. He wasn't giving you the clearest cut of confirmation. And as a result, that was point number 4. Now, if we go to total, we were looking at the total 2 market cap. And if I go there now, this is the kind of analysis you can indeed be doing for yourself in these situations. Total 2 on the same period was also illustrating the same. Now total 2 is going to have a lot of Ethereum already in it, but it was already illustrating and breaking a little sooner the falling wedge component here, where we were expecting a downside move. Marginally lower lows, not following through, and then failure to make a new low. This was warning us early. This was warning us early that we might be on the wrong side. And this was looking at it differently with some of the other old market coins, market cap included therein. So you can see there. What else did we discuss in our premium? And I did a jump share where we went into all this detail exactly like I'm doing this. And I'm giving this to you for free. It's a learning. Volume by price was at the just-in-time method. You'll learn what just-in-time is if you do a program. The link's below. Book in, grab a call, learn to imply and to implement scientific stress testing, not belief systems, in your trading, and be an HVF method trading stock. Grab the free mini series. If you don't have a bean to your name, it's there for you. It's absolutely free. So volume by price. What did the volume by price on Bitcoin say? It wasn't particularly supportive of downside, and neither was it on Ethereum. We teach you how to use this, and you'll have to, as I say, do a program to check, but I will just do a quick before the major impulsive move occurred. You had quite a high line of volume by price in terms of something that was supposed to be bearish. Similarly, on Ethereum, you had quite a high line alongside the legacy just-in-time, this fat green line that came all the way from the bull market of 2017. So you were either going to let go there, or you were tapping to get back above. So the volume by price was not so supportive. We wanted flat and low volume by price. We wanted the highest volume by price to be the red one to be somewhere lower down. It wasn't. So we weren't 100% happy. But sometimes that might correct itself while still in the manufacture of the pattern, and that hadn't begun to occur. So here were all the reasons we were discussing. While still 341, we had shorted from 352. We're sitting with $10 of profit. We're discussing all the reasons why the trade might fail. And I actually reduced size in profit. And this is the thing nobody ever does. That's a newbie. You add size. You look at your P&L. If you're making money, you add size. If you're losing money, you panic and you close. That's typically what newbies do. That is very, very typical newbie behavior. In actual fact, I felt the confidence in the trade was ebbing, and I started to reduce size, and due to an excellent limit sell order at 352 that had got us in very favorably. Let's not show you on the upside down chart. Let's show you on the correct side one, where we got filled short over here by the 352. Was very, very favorable. We closed most of our positions with profits. Now, given that Bitcoin looked better for upside than this one ever looked for upside, the minute it was clear that there was impulsive action, and I didn't get the reason until Twitter explained it to me a whole bunch later than everyone else. I don't need to know the reason. I could see it was starting to move impulsively. This was a major alert when it took that high. We closed in full on Ethereum, and I went long Bitcoin. That's right, having spoken short Ethereum, we closed it early because it wasn't performing, and we went long Bitcoin. So what does that lead to? So in the end, and just purely because there's so many. This was the draw, by the way, we shared. This I put out a lot later once we then entered. Sorry, Twitter gets served last if I have the time. I have a premium community that have respected me with money. And I have my own trading accounts and their trading accounts if they want to act that need seeing to well before. So by the time this Bitcoin chart went out, our draw was already done. We were already long and it was already well in the money. And that tweet said, earning it back by being wrong and long on Bitcoin and calling for 11,705 to be met as a relative high point. What will happen after that? We'll see. But we'll close there. So actually, with the trade being discussed from the 6th of October, which was Ethereum-based trading, you can see the Ethereum, and you can see actually we still realize small positive amounts. There was a loss there on Bitcoin and Ethereum, and then boom, 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 boom. With the run of Bitcoin to our target, we went from 20.8 on one of a number of accounts I trade to 22.79. So we were wrong and we were up. I made $1,000 on DOT that I was short, and I made $8,000 on other accounts, also short Ethereum, and that was shit money compared to what I was hoping to get had I been right. But the difference is, in that grid that I started to draw, is in the end, we were wrong and we made some positive money. Overall, the experience is positive to the P&L. Being wrong. And this once again brings the box back up that I was highlighting to you as to how and where you're at. I actually lost money sometimes when I was even right, when I first started trading. You can only imagine how frustrating that is. And that would have been pyramiding, money management, emotionally reacting, every rookie mistake. And I remember those days. It was like, wow. When you stop, when you make maximum money when you write, let's just write it in again and go through the grid one more time. Be right. That's negative P&L. That's positive P&L. You can leave something for no P&L effect. In a probability-based game, absolutely accept you will regularly be wrong. If you're looking for upside of sixes right the way we've landed 62.5 risk reward, right the way through to 62.5 reward, you're not getting that often. And you're getting quite a few wrongs in between. Right and wrong and neither. Hideous handwriting, but anyway. Right and wrong and neither. By the time you start being wrong on your original view, and instead of it being a negative P&L event, here, you actually start to even get small positive P&L events you're going to be a winner in trading. In fact, if you can just get it to be a zero P&L event or a very small negative when wrong, you're going to start being a winner. If you can ensure it's a zero event when neither, or occasionally maybe a small positive, you're going to stay in the game. And when you're right, you're damn right. That would have been a 6-digit plus trade across 5 or 6 different accounts for me if it had delivered the P&L target. It didn't. Ifs, buts don't count for anything, but we would have been damn right on that. And instead of it being a zero P&L event, it was a positive P&L event, but we weren't right in this case. We were slightly right in the end. We were wrong on view and direction, but in terms of P&L, we were slightly right. I made 2 Bitcoin and a couple of grand on DOT and Ethereum in other exchange-based accounts. Overall, it wasn't a loss money event. The game is being wrong and not losing much money. If you can get that part right, you will be long and sustained in all trading endeavors, whether crypto, whether FX, whether equities, anything. Everything I am saying to you is 100% as it occurred. And you will, if you can, you want to aim for that point. There's never an outsized loss. You recognize quickly when you're going to be wrong. If you're awesome and have an awesome method, that actually means when you're wrong, you're going to be 180 degrees wrong, and you show the dexterity to be able to recognize this early and flip. Actually, you make money when you're wrong, as well as when you're neither, or you don't lose anything when you're neither, and then you make money when you're right. You now have a real trading system. And trust me, we were watching this trade really close because we went for it big time. And I was publicly wrong, publicly shamed by the low non-trading Twitter trolls who made no money out of this event whilst we did. And that's the key element of trading, learning to be wrong in the right way. Okay, that's pretty much what happened post-mortem. 100% wrong on direction, and flipped into Bitcoin and took all costs and all accounts that might have had any negatives, and most of them actually had positive closures, into the positive, so that the overall P&L effect was a positive 1 across all accounts. If you can do that, you're going to survive just fine. And in some ways, I'm almost more proud of not losing money on a trade I had an immense amount of conviction in at one point, and actually coming out higher up, than I am of being able to be right. But one will get you greatly hated, the other will get you great adoration, but the people are all focused on the wrong thing. Make money, don't be right. That's it. Okay, what comes next for cryptos? Well, I'll be discussing that in our premium community. You're welcome to jump in. By the way, I didn't finish here. Bitcoin, how did it go? So there was our flippening on Bitcoin. That, if you want to know where that Bitcoin got made, and actually I had fairly chunky size up to here, and then I took some off, and there was the final close, 11,705, now trading 11,400. If you can be wrong and flip long there and get out there when you're wrong, you've just landed yourself. By the way, the stop was there, 10,525, and the takeout was there. So if you want to see what the final risk-reward ratio earned for being wrong was, it looked something like this. The best way to punish your haters is with your success. They hate you even more for that. That's a fact, I'm afraid. Be wrong and land a 6.28. And you can only do that with a method where you are aware that if you're wrong, you're going to be 180 degrees wrong. Because most trading methods, it didn't work. It's not, no, it's diametrically 180 degrees opposed to you. Therefore, if you actually reverse view immediately, you can still make money. How many methods do you know that do that? Because we are volatility focused as a trading method, you can do it. Every other scalping, this MACD's stupid ass, money, momentum, stock to flow, every other method of trading cryptos or anything else that is not focused on volatility, it is the most unique and determining feature of our method. And if you don't recognize that, you shouldn't book a call, because you're not going to make money when you're wrong, and you don't understand the power of taking your account up when you're completely wrong. And then this entire watching of this YouTube for you has been a waste of time. But in the end, I'm happy with that. I got out at 10.11.7 to the dot on something that's now trading 11.475, and I was entirely wrong on the direction that I thought it would go. Okay, I think I've made the point. That's the risk reward, 6.28. It's kind of an average. It's not special. It's roughly there or thereabouts. Let me tell you, having taught in an academy, having been amongst hedge funds, big macro, ex-Goldman, ex-Merrill, ex-Bammel guys trading for their own account, levered up well into the millions of pounds. Most do not. From the pros, and certainly from those learning rarely get one-to-one. They snatch profits and they let losses run. The pros probably occasionally get bigger than 2, 3s and 4s risk to reward, but usually they're waiting for information from their mates and have conviction of insider knowledge. That was my overall impression. Who's going to happen? A lot of rumor chasing, a lot of news, a lot of guesswork, a lot of other things. Not most of it technical was my experience. Very few people land 6.28 generally. And almost no one does it when they're wrong. And that's the power of 180 degrees volatility based trading, recognizing you're wrong, flipping and getting paid for being wrong. And learn to be wrong like me, like the video says, and go and laugh at the trolls that are so happy that I am wrong. They're so happy to see a man fall from grace. I had some comments say, "You've lost all credibility." I'm delighted not to have his Twitter following anymore. He doesn't understand trading. Okay, guys. Remember, the mini-series is free. It's below. Book a call if you want to become part of the community. And we'll be looking at the markets. And we'll be getting things wrong in the future. And we'll get some things right every now and then as well. Bye for now. And thanks for watching.